Let me give you a number that should get your attention. In 2022, the average 401k lost $34,000 in a single year. Not a crash, not a collapse, just a bad year. A 20% drawdown, normal by historical standards. Now I want you to think about what a 40% drop looks like. If you have $200,000 saved right now, a 40% drop leaves you with $120,000. If you have $400,000, you're sitting at $240,000. If you've spent 20 years building a $600,000 retirement account, you'd wake up one morning and $240,000 of it would be gone. And here's the part that keeps people up at night. It's not a question of if a 40% drop will ever happen. It's happened before, multiple times. And the people who panicked, who didn't understand what was actually happening to their money, made decisions that cost them everything they had lost and more. So in this video, I'm going to walk you through exactly what happens to your 401k during a 40% market crash, what it means, what it doesn't mean, the mistakes that turn a temporary loss into a permanent one, and the specific moves you should make right now before the market gives you a reason to panic. Stay with me on this one. This could be the most important 15 minutes you spend on your retirement. My name is Reid, and I'm a financial educator who has spent years breaking down the parts of personal finance that most people only learn after they've already made a costly mistake. I've watched people make every single error in the book when markets get ugly. And the most heartbreaking ones are always the same. Someone who did everything right for 20 years, who saved consistently, who never touched their account, and then at the worst possible moment, fear took over. They made one decision, and it wiped out years of compounding. I don't want that to be you. So let's break this down properly. No panic, no hype. Just the facts about what actually happens to your 401k when the market drops 40% and what it means for your real life. First, let's define what a 40% crash actually looks like historically, because this isn't hypothetical. The 2008 financial crisis, the S&P 500 dropped 56.8% from peak to bottom. Not 40, 56. If you had $300,000 in your 401k at the peak in October 2007, by March 2009 you had roughly $130,000. That's $170,000 gone. The dot-com crash from 2000 to 2002, the S&P 500 lost 49.1%, another near 50% wipeout. COVID in 2020, a 34% crash in 33 days, the fastest 30% decline in stock market history. 2022, down 19.4% on the S&P 500. But if you held growth stocks or a tech-heavy portfolio, you were down 40, 50, 60%. These are not once-in-a-generation events. These are the normal operating conditions of the stock market over a long enough timeline. A 40% crash is not an apocalypse. It is a scheduled inconvenience that most investors are completely unprepared for psychologically. Now let's talk about your 401k specifically. When the market drops 40%, your 401k balance drops in direct proportion to what you hold. If you're 100% in an S&P 500 index fund, you're down 40%. If you hold a target date fund that's split between stocks and bonds, you might be down 25 to 30%. If you're close to retirement with a conservative allocation, maybe down 10 to 15%. Here's the critical thing to understand. The loss is not real unless you sell. I want to say that again because it is the single most important concept in this entire video. If your 401k goes from $300,000 to $180,000 and you don't sell anything, you haven't lost $120,000. You have experienced a temporary reduction in the paper value of assets you still own. Every single share you had before the crash, you still own it. You haven't lost shares. You've lost the current dollar value of those shares, which can and historically always has recovered. The loss only becomes permanent the moment you sell. Let me show you how this works in real numbers because this is where most people's understanding breaks down. Say you have 1,000 shares of an S&P 500 index fund. At $300 per share, your account shows $300,000. The market crashes 40%. Your shares are now worth $180 each. Your account shows $180,000, but you still have 1,000 shares. When the market recovers back to $300 per share, which historically it always has, your account is back to $300,000. You lost nothing. You went for a very uncomfortable ride and came out exactly where you started. Now here's where it gets even better if you're still contributing during the crash. This is something almost nobody thinks about. If you're still working and contributing to your 401k during a 40% crash, you are buying shares at a 40% discount. Every paycheck contribution is purchasing more shares than it would at the peak. Let's say you contribute $500 per month. At $300 per share, you're buying roughly 1.67 shares per month. At $180 per share during the crash, you're buying 2.78 shares per month. Same $500, two-thirds more shares. This is called dollar cost averaging, and a market crash is when it works most powerfully in your favor. The people who kept contributing through 2008 and 2009 bought the S&P 500 at prices that don't exist anymore. Those shares are worth 3, 4, 5 times what they paid. Now let's talk about the scenario that actually destroys retirement accounts. And it's not the crash itself. It's the panic sell. It really is. Here's what happens psychologically. The market drops 10%. People feel nervous but hold. It drops 20%. People start watching their accounts obsessively. It drops 30%. The news is wall-to-wall catastrophe coverage. People start telling themselves they'll get back in when things stabilize. The market drops 40%. They can't take it anymore. They sell. They lock in the 40% loss permanently. Then, because markets don't announce their recovery, the market starts climbing back while they're sitting in cash, waiting for stability. They watch their account not participate in the recovery. At some point, they feel safe enough to get back in. Often after the market has already recovered 20 or 30%, they buy back in at a higher price than they sold. They bought high, sold low, and then bought high again. This is the sequence that takes a temporary 40% paper loss and turns it into a permanent 50, 60, 70% real loss of purchasing power. And the data backs this up. Dalbar, a financial research firm, has tracked investor behavior for decades. The average equity investor consistently underperforms the S&P 500 by 3 to 5% per year, not because they chose bad funds, but because of bad timing decisions driven by emotion. Over 30 years, a 3% annual underperformance gap on a $300,000 portfolio means you retire with roughly $400,000 less than if you had simply done nothing. That is the real cost of panic, not the crash, the reaction to the crash. Okay, so now let's talk about what you should actually be doing. Not when the crash happens, but right now, before it does. Because the decisions you make now determine how you behave when fear is at its peak. Step 1. Know your allocation and make sure it matches your timeline. Open your 401k right now and look at what you actually hold. Not what you think you hold, what you actually hold. If you're 25 years from retirement and you're 100% in stocks, a 40% crash is an opportunity. You have time to recover and buy cheap for years. Staying aggressive is correct. If you're 5 years from retirement and you're 100% in stocks, a 40% crash at the wrong moment could force you to delay retirement or withdraw at depressed values. This is called sequence of returns risk, and it is one of the most underestimated threats to retirement security. The general rule of thumb, and this is a starting point, not specific financial advice for your situation, is that as you get closer to retirement, you gradually shift more of your allocation into bonds and stable assets. Not because stocks are bad, but because you reduce the window of vulnerability. Step 2. Make sure you are not treating your 401k as an emergency fund. One of the biggest reasons people panic sell during crashes is that they have no liquid savings anywhere else. When the market drops and they also face an unexpected expense, a job loss, a medical bill, a car repair, they have no choice but to pull from the 401k. That forces a sale at the worst possible time and triggers income taxes plus a 10% early withdrawal penalty on top of the loss. The solution is having 3 to 6 months of living expenses sitting in a high-yield savings account, completely separate from your investment accounts. Right now, high-yield savings accounts are paying 4 to 5% annually. Your emergency fund should be working for you while it waits. This one step removes the forced seller problem from your life permanently. Step 3. Turn off the noise when the crash comes. Make this decision right now before you're emotional. Decide in advance, and if the market drops 40%, you will not log into your 401k account more than once a month. That sounds simple. It is extremely hard to execute in practice, because every instinct when something is going wrong is to watch it, monitor it, refresh it. And every time you log in during a crash, you are giving yourself another opportunity to make an emotional decision. Fidelity did an internal study and found their best performing accounts were those belonging to people who had either forgotten they had the account or were no longer around to touch it. No interference. Maximum compounding. Step 4. Keep contributing. Do not stop. If you stop your contributions during a crash because you're scared, you are doing the exact opposite of what the situation calls for. Continuing to contribute during a 40% crash is the equivalent of buying a house in a neighborhood where every home just went on sale for 40% off. You don't stop buying in a market you believe in long-term just because prices temporarily dropped. And if your employer matches your contributions up to a certain percentage of your salary, stopping contributions during a crash means you're leaving matching money on the table during the exact period when those dollars buy the most shares. Step 5. Do not try to time the bottom. Nobody, not hedge funds, not professional traders, not the most respected analysts on Wall Street, can reliably identify the bottom of a market crash while it's happening. They can identify it in hindsight. In the moment, it always looks like a pause before more drops. The strategy that works is not timing the bottom. It's being continuously invested so that when the recovery happens, you are already holding the shares that are now worth more. The best single trading days in stock market history almost always come immediately after the worst days. If you're sitting in cash when those days hit, you miss the recovery entirely, and you never get those days back. Here's what I want you to take away from this. A 40% market drop is not the end of your retirement. It is not a sign that the system is broken. It is not your cue to take action. It is a normal, recurring feature of building long-term wealth in the stock market, and the people who come out ahead are always the ones who prepared for it emotionally and financially before it happened, not the ones who reacted to it in the moment. The real threats to your retirement are not the crash itself. They are the panic sell, the missing emergency fund that forces a withdrawal at the worst possible time, the decision to stop contributing when shares are at their cheapest, and the belief that sitting in cash feels safer than staying invested. Handle those four things now while the market is calm and you can think clearly, and a 40% crash becomes something you survive easily and actually benefit from if you're still in your working years. Do not let fear make decisions that math should be making. And I'll leave you with this one last thing to remember. The loss is only permanent if you sell. If this video gave you a clearer picture of what's actually happening inside your 401k, make sure you subscribe, because we cover exactly this kind of topic regularly. The things about your money that nobody explains clearly until it's already too late. I'm Reid. I'm rooting for you, and I'll see you in the next one.